Hi everybody, welcome back to the Velocity Banking series. My name is JoJo and this is JoJo Budgets. Thank you so much for joining me today. If this is your first time viewing these videos, they are intended to be watched as a series. This is the third video in this series, so there are two prior videos. I will leave them linked in the description box below, but my family and I implemented the Velocity Banking strategy to help us pay off a large student loan debt, and that began in August of this year. So it's only really been 2 months that we've implemented this strategy, and when I presented that, there was a lot of questions and some confusion, which is understandable because there's a lot of videos on the actual concept, but not videos showing real world numbers, people who are actually doing this and showing their numbers of how they're implementing this strategy. So that's where I started this series. And the information is intended to build upon itself. Today's video, we're going to be figuring out our cash flow. But just to recap from last week, what we covered in video 2, I have showed you guys what our lines of credit and loans look like. And that was based on my suggestion at the end of video 1 after we looked into how to determine what debt is a line versus a loan. And I had suggested that on a sheet of paper, you do this yourselves, and on one side write down your lines of credit, and on the other side write down your loans, and then write down how much money you paid towards interest in the month of August on those different types of debts. And I showed you what our interest would have looked like had we not started the Velocity Banking strategy in August on our lines of credit and our loans, and then what our savings was since we did implement that strategy in August. We also looked at an amortization schedule chart, and I had showed you guys what that looks like. The trajectory of the lines, it looked at how much money is paid towards principal, how much is paid towards interest, and the timeline on that, and how the trajectory of those lines and how the timeline to pay off an amortized interest loan is significantly changed when implementing a Velocity Banking strategy. By paying down a large chunk of principal on those types of loans, it can significantly reduce the amount of interest and the amount of time it takes to pay off those loans. And that was displayed in that chart. I wrapped up last week's video because we were talking if this is a strategy you are interested in implementing yourself, what I have learned and my journey, what steps our family took to implementing this strategy. First, I don't have it listed here, but I've mentioned it in video 1 and video 2, is to have a functioning and realistic budget. That is key before beginning this strategy. You need to know your numbers. And in order to know your numbers, you can calculate your cash flow. And I'm going to be showing you guys, I was leaving off last week by saying I'll show you what our cash flow is, showing you our real numbers, and then how we determine what loans to pay off first. So if you have multiple loans that are amortized interest, how do you know which one to tackle first to get the most bang for your buck? And then how we are using our lines of credit. I decided to break this up into separate videos for each bullet point. So in today's video, I'm going to be showing you guys our cash flow. I'm going to switch you over to an overhead view and we'll start crunching the numbers.
Okay, so here we are looking at cash flow, which the variables that go into this equation are income minus your fixed expenses or your bills minus your variable expenses. And I'm going to pull in my Paycheck budget sheet so you guys can get a view at what goes into our fixed expenses, variable expenses, and income. So what I used to calculate our cash flow was using this expected amount right here. And you can see this is a paycheck budget sheet I just filled out yesterday. I'll leave a link to that video in the description box below if you want to check out how I plug in these numbers. But this is where my husband and I, for our income first, let's look at that first. Our income, we get paid every other week. So you can see for the month of October, we're getting paid on the 9th and the 23rd. And those are our paychecks. So these are 4 paychecks total for right here. And then we do also have a third income that is once a month. So when I was looking at our monthly income, you can see that income 1, I expect it to be $2,870, but that's for 2 weeks. So I times that by 2, and then the $1,000 times that by 2, and then that $915, since that's only once a month, that just gets added once. So let me show you guys what that would look like mathematically. So to calculate our income, so that's why before even starting this journey, it's important to have a budget so that you know these numbers. If you're not comfortable with those numbers or not familiar with them or know what they are, I would say put a pause, get that under control before you implement this strategy into your finances. Income, we have that, and I'm going to be using my orders of operation correctly this time. Someone had pointed out to me in my first video, I'd forgotten to use brackets when I was putting in the calculation for my average daily balance. So that mnemonic, the please excuse my dear Aunt Sally, so sorry. Thank you so much for pointing that out. That can end up with very different numbers when you don't use your operations correctly. So starting with parentheses, the income 1, $2,870 times 2, since we get paid every other week. And then income 2, $1,000 times 2. And then we have that third income that is once a month, and that is for $915. Okay, so looking at our income, we will take that $2,870 times 2, add it to 1,000 times 2, add it to the 915. So our income is every month, and I underestimate these. I would recommend that as well. Underestimate your income, overestimate your expenses, so you can give yourself a nice cushion. So it is $8,655. Next is fixed expenses. Now these are all of our fixed expenses. I plug them in to help me highlight things using the Budget Mom method on my household calendar. And then I do also have a fixed expenses table on my paycheck budget sheets. So you can see each of these variables. This right here, I have that cash flow equation on my sheets. I use it for rollover, and I use it for zeroing out our paycheck number 2 at the end of the month. So we went over income, now we're over here to fixed expenses. And each of my paycheck budget sheets is not going to account for the month's worth of expenses because it only covers 2 weeks worth. What I ended up putting together when we first started budgeting, because we began really budgeting in September of last year. And to be honest, I didn't even know when some things were coming in. I was surprised by some bills I didn't know that we actually were paying money for, especially subscriptions that are on auto pay. Those were a killer for us. What I ended up putting together, and these were just you don't have to have anything fancy to start a budget. I repurposed this calendar. You know, it's just printed on regular paper using Microsoft Word. You can use a 50-cent notebook from Walmart or the Dollar Tree. And then I had these index cards lying around. And so I just began compiling a list of our bills and when they actually came through, not when I thought they were coming through. And then in parentheses, I put next to that what the expected amount was for each of those bills. And these are called fixed expenses. So this amount should be pretty consistent. And then the other one down here, our childcare. It's not as consistent as some of these monthly bills, right? Our daycare is the only one we have to pay now, but that's every other week, so it varies. So I can't really write a date for it, but I just needed to remind myself to account for that. So when you add all these together, including daycare, for fixed expenses, all of our bills, that comes to $5,058.70. And that does include debt payments as well, you guys, like the HELOC. It varies. It was $92 last month. It's expected to be a little over $50 this month. I overestimated it in this calculation at $75. Next is variable expenses. And these are our different variable expenses. I'm married, I have 3 kids, we have pets, we own a home, and we own 2 vehicles and a motorhome. So that encompasses what makes up our lives and our variable expenses. This is going to be very different from person to person, family to family, lifestyle to lifestyle. So when you're doing your budget, be realistic about these. And, you know, if your shovel isn't big enough for you to maintain a certain lifestyle that you want, you have to be realistic, because if you can either make a bigger shovel or cut expenses. So then what we budget, this is what we budget for all of our variable expenses. That totals $915. And that's to cover 2 weeks worth of variable expenses. So to figure out a month's worth, we say that $915 times 2. So 915 times 2, that equals 1,830. Now, we'll figure out our cash flow. So we will take the $86.55 minus $5,058.70 minus 1,830. This is our cash flow. $1,766.30 is our cash flow. So figuring out your cash flow as a next step before you implement velocity banking. Again, I would refer you to watch Think Wealthy with Mike Adams, because he suggests having $500 of cash flow before you start the velocity banking strategy, because you're taking money from a line of credit to pay down a loan, but you need to use your cash flow to pay down the principal on that line of credit. Otherwise, you're just going to get deeper and deeper into a hole. So before we even considered starting the velocity banking strategy, we knocked out some other debts, just using the debt avalanche, debt tsunami, and debt snowball methods, and that built up our cash flow. So we started this journey with more than $500 of cash flow. So again, if you're finding that you're not quite at $500 of cash flow, go back to your budget. These three variables, bigger shovel or cutting expenses. Keep these lean and mean and be realistic about your variable expenses. All right, everybody, that is going to wrap up the Series 3 video looking at cash flow for the Velocity Banking series. Next week, I'm going to be posting a video where we are going to look at how to figure out which loan to tackle first. And again, it's crunching numbers that came from watching videos by Think Wealthy with Mike Adams. I'll leave the video that inspired this in the description box below if you want to watch that prior to watching the Series 4 video, but it'll be showing our loans and how you can use calculations to decide which loan will give you the most bang for your buck as far as interest savings. Thank you all for joining me. If you enjoyed this video, please give it a thumbs up. If you are enjoying the contents of this channel or this series, please consider subscribing and check out some of my other videos. I do time blocking for productivity and also budgeting videos. And I had just done a quarterly debt and net worth assessment where I updated our debt balances and our net worth over the last 3 months and our progress there. But thank you all so much for stopping by, and I will see you on Sunday for my time block video.